So as we move on, or we continue on here, let me see what we are going to, we're talking about transactions. Now, we measure these business transactions related to money, which is called that money measure. Remember, everything we do in the United States deals with the US dollar. So depending on which country you're in, if you're in Russia, it's going to be the ruble. If you're in France, it's going to be the euro. But in the United States, we're dealing with the US dollar. International transactions are more complicated because we're dealing with a couple forms of currency. And how many of you guys have ever looked at a newspaper and you look at the foreign exchange rate? So they compare the US dollar to all these different types of currency. And they can fluctuate. And it's a little more risky just because we're dealing with more of a global scale. Different governments. Look what's happening right now. I don't know this, and I may be foolish to even suggest this, but my guess is the euro is probably taking a little bit of a hit right now because of what's happening in France. With all of the turmoil and commotion, that's going to hurt their currency. Would that make sense? What's happened with Russia's ruble? Hasn't it lost like 80% in 1 year? Am I off on my numbers? But it's like crazy how much the ruble has been harmed. And so the value has been reduced significantly. We all know the peso, that's happened with the peso also. So for U.S. companies, we're going to deal measurement based on the U.S. dollar. Now, this is a couple years old here, almost 3 years old, but it shows the dollar in Australia based on the US dollar. We get $1.07 US dollar to an Australian dollar. Canada, as of 2012, was even with us. There have been times that the Canadian dollar is about, well, it can range anywhere from even to 20 cents higher than the US dollar. The euro right now is at 132. I'd love to know what it is today. It's just a curious. What? We need to Google it and find out what that is. Look at the ruble, guys. Even 3 years ago, the ruble was, Russian ruble was 3 cents. And it's deflated even more. Sad. So we're going back again. This separate entity concept. Organizations are separate entities from its owners or from its customers, from its creditors. It sits on its own. Even though you may have people that owe you money or people that you owe money to, you'll show those transactions on your financial statements, but they are separate from you as an entity. It should have its own set of financial statements. Each entity, its records and reports should refer only to its own affairs. There are 3 types of primarily the ones we're going to talk about here, of entities. The most common entity in the United States, or I should say the largest amount of businesses are set up as sole proprietors. It's easy to do. Sole proprietors are basically owned by just one person. The owner gets all the profits, but the owner also has to take the losses. And the negative part about it is the owner's responsible for all the debts. Okay? A partnership is like a sole proprietorship, but it's 2 or more people. I want you to know these, okay? So with a partnership, they share the profits or losses however they determine the relationship in their agreement. So it may be the losses and the profits are shared 50-50. There may be 3 people and one gets 40% and the other 2 get 30% each. If a sole proprietor, if the individual from a sole proprietorship dies, what happens to the company? It's gone. In partnerships, if one of the partners dies, the company technically can be dissolved because a partnership is no longer existent in the manner in which it was set up. The negative with both a sole proprietorship and a partnership is that the sole proprietor or the partnership have something called unlimited liability. What that means is any debts of the partnership or of that sole proprietorship get taken on individually by the person, and that can be a scary thing. One way to avoid it is something called a limited liability partnership. I'm not going to talk about it. I'm not going to ask you about it. Corporation. But I want you to know about a sole proprietorship, a partnership, and a corporation. Corporations, while there are less number of corporations than sole proprietorships in the country, corporations provide for about 90% of all the revenues of businesses. So while corporations may be fewer in number, they're definitely the largest in revenues. Businesses are allowed to be a corporation through the state. So in the state of Minnesota, when I wanted to become an S Corp, like Keith is, I had to go and apply with the state of Minnesota to become a corporation. The state of Minnesota, or whatever state you're doing business in, grants you the permission to be a separate entity. It happens through the state. It does not happen through the IRS or through the federal government. It's through the state. The owners of a corporation are called stockholders. Okay? Now, a sole proprietor, he's called a sole owner. A partnership, they're called partners. In a corporation, if you own stock in a corporation, you're called a stockholder, or you can also be called a shareholder. So know, if you saw a question that said the term stockholder refers to owners in A, a sole proprietor, B, a partnership, or C, a corporation, what are you going to say? Get it? Stockholders do not directly control the corporation, but they elect a board of directors to make those decisions for them. So think of Delta Airlines. We may own stock in some company, but do we really have a say in the company? No, we're just investors in the company. But a separate group of people run the company. And the board of directors is voted on by all the stockholders, and then from there determine the plans of the company. Stockholders, this is the cool thing. You know how I was telling you about that unlimited liability? Well, that's not true with stockholders. The advantage of a corporation is that stockholders have what's called limited liability. Their risk is only limited to the investment they have in the company, period, and no more. Okay? The other beauty with a corporation is if a stockholder sells the stock, it doesn't affect the life of a corporation. The life of the corporation continues on no matter who the stockholders are.
So is when you're talking about a business, and in their title, at the end they got LLC, is that limited liability corporation?
No, that is called a limited liability company. And what's happened is because partnerships and sole proprietorships have become very a negative connotation due to that unlimited liability, the states have set up a structure that kind of gives you the best of both worlds. A limited liability company, or an LLC, can be a one member or two or more members. And it basically allows you limited liability. So you get those protections like a corporation, but the ease of setup and the operation is similar to a partnership and sole proprietorship. I think they might talk about it in this chapter or the next chapter, but they don't really go into a lot of detail on it, so I'm not going to bring it up to you guys. But it's huge. It started in the 90s in Minnesota, and it's just taken off. In this day and age, with how everyone is so lawsuit, get a buck, happy, anybody starting in business would be foolish not to be in some type of protected structure, because everyone's sue happy. And then especially if you're dealing with anything that could cause harm to others, you definitely need to protect yourself.
So mine is calling for hope, Inc. Everything I write.
Oh, you have to. Just so it shows you're representing them, you know. So as you can see here, guys, number and receipts revenues of U.S. proprietorships, partnerships, and corporations. Do you see in millions the number of proprietorships are about 23 million? And partnerships are about 3 million, and corporations are only about 2 million. But out of those only 2 million of corporations, they create revenues of over $24 billion, where proprietorships only have revenues of about 1.3 billion. You see? So the point here is to say, while we have so many businesses that are operating as proprietorships or partnerships, the real money is coming in from those 2 million corporations. Now, let's look at this. This is a great way that we can talk about some of this information. We're going to match each description with the appropriate term. Now, guys, you can call it out, but I'm not going to call on you. So our choices are business transactions, corporations, money measure, partnership, sole proprietorship, or separate entity. Owners have limited liability. What do you think? B. Whoops, I did them all. Requires an exchange of values between two or more parties. Transactions, business transactions. Owned by only one person? Sole proprietor. Right? Owned by only one person? E. Multiple co-owners. Partnership. An amount associated with a business transaction. Money measure. Management appointed by the board of directors. Corporation. Distinct from customers, lenders, and owners. Yes, separate entity. Biggest segment of the economy. Awesome. You'll see those again. Okay? Is that like a hint? Like, you'll see those again. I don't know how more clear I can get. Okay, moving on. Financial position refers to the company's economic resources. And the types of economic resources would be cash, would be inventory, buildings, and then the claims against those resources, which is the liabilities, and the claims, inventory, and the claims against those resources at a particular time. So financial position is basically what we will show as what's called the balance sheet of a company. The financial position is going to show all the assets a company owns, and then the liabilities a company owns, and then the owner's equity, that amount the company's worth is after that. Every company has two types of equity: creditor's equity and owner's equity. So basically the way they're trying to frame this is, if you show assets are equal to equities. There's two types of equities. There's creditor equities. That's money we owe the creditors. And then the leftover is called owner's equity. Money we have invested or left over for the owners to enjoy. So you see here, economic resources is equal to creditor's equity and owner's equity. So creditor's equity, we're going to call liabilities. So know that. Know that the term liability means that they're obligations, remember, that will provide, require a future sacrifice. We've got to pay back those claims. They're called liabilities. And this is the most important thing in accounting. And you'll see why 2 weeks, 3 weeks, 4 weeks, 8 weeks later. This is called the accounting equation, and you will see this. Assets, economic resources that provide a future benefit equal liabilities. What are liabilities? Obligations that have a future sacrifice plus equity, the remainder in a company. This accounting equation always makes sense. This is why I like accounting so much. It will make sense. It always does. Now, guys, if there's a tough week, it's week 1 and 2. You got to hang in there with me. I promise you, after week 2, it's going to all start clicking. But you're going to get hit with so much information, your head's swimming. But if you hang in there and you really give it the time, you're going to go, oh, I get it now. Okay? So this accounting equation, assets equal liabilities plus owner's equity, is the background to everything we're doing here in accounting. A, assets equal L, liabilities plus OE, owner's equity. Make sense? The two sides of the equation need to always be in balance. So do you see here? Assets are going to always equal liabilities plus owner's equity. So let's just take it like this. If you have $10,000 of inventory, $5,000 in cash in the bank, and $30,000 in automobiles, what are our assets there? 45,000? So our assets are going to equal 45,000. If our liabilities are 25, what will our owner's equity be? What? 45 minus 25 equal 20. It has to always work out. Do you get what I'm saying? Assets are economic resources. They include cash and something called accounts receivable, money that is owed to the company by customers. Then there are various types of items that aren't necessarily cash, but that have value, such as buildings, equipment, land, okay? Then there are other types of items that really don't have a physical, tangible value, but do have a value. They may be copyrights, trademarks, patents. So when a company, let's just say that, Keith, am I picking on you too bad? Keith's sheet metal company wants to buy St. Cloud sheet metal for $1 million. We can go and look at St. Cloud's financial position and see they have assets only of $600,000. Why would Keith spend $1 million on this company when they only show assets of $600,000?
Does he knock them out of the running for something else?
There's some intangible benefit he's willing to pay for, isn't it? Okay? There's worth there that might not be on the financial statements, but he knows about it. So oftentimes, people purchase something called goodwill when they buy a company. Because there's value there, you just can't see it. But it's there. It might take the competition away. They might have amazing customers that he's going to get them all. But there's a sense of a benefit. You just can't touch it. Make sense, guys? That is what's called intangible assets. Liabilities are obligations that will require future claims or paying back. Those are going to be things, amounts we owe suppliers, called accounts payable. They might be monies we borrow from a bank. They may be salaries and wages we need to pay the employees, or they're taxes that we might owe to the government. Now, there may be sales tax that you've collected you need to turn around and pay. There may be employment taxes. And if you're a corporation where the corporation pays their own taxes, you may have a payable such as taxes that you owe to the government. These are all items that you owe to people and you need to pay them with future monies, which is a sacrifice you're taking away to pay them.
So where would dividends fall in, like, to shareholders?
That's going to be under equity. Great question. Hang in there with me. You're good. How many of you guys have heard of dividends? Okay? Dividends are paid out to stockholders because they've invested in the company. And so remember, we're talking about assets. We're talking about liabilities. Now we're talking about owner's equity. Now, in Chapter 1, we're talking about a real simple form of organization, like a sole proprietor. So we're really not talking about a corporation. But the owner's equity of a sole proprietorship would be similar to stockholders' equity of a corporation. You see? Because the stockholders own it. So the stockholders' worth is in that equity. And when they receive dividends, it reduces their stockholders' equity. Okay? We'll talk about that in a minute. So owner's equity represents the claims by the owner of a business to the assets of the business, which basically means the assets minus whatever they owe to creditors, the rest is left for them. It's what's allowed to the owners after everything else has been settled. Theoretically, owner's equity is what would be left if all liabilities get paid. Sometimes we call it net assets. Oftentimes in governmental accounting, we call it our nonprofit net assets. But we can look at it like this. You know that accounting equation we showed, like assets equal liabilities plus owner's equity? Here we're just taking this accounting equation and changing it. Owner's equity is equal to assets minus our liabilities. Make sense? Yes, no?
Yes, yes.
Okay. So, owner's equity is affected by the owner's investment and withdrawals from the business and by the business's revenues and expenses. So, just like with a shareholder, when shareholders or when owners invest money into the business, the owner's equity increases, doesn't it? When when owners take money out of a business, it reduces their owner's equity. Withdrawals. Revenues increase owner's equity, and expenses decrease owner's equity. When revenues exceed expenses, we have what we want to have, net income. But we don't want this, guys. When expenses exceed revenues, what happens? We have losses. Okay, let's look at this one. Stevenson Company had assets of $140,000 and liabilities of $60,000 at the beginning of the year, and assets of $200,000 and liabilities of $70,000 at the end of the year. During the year, $20,000 was invested in the business and withdrawals of $24,000 were made. What amount of net income did the company earn during the year? So let's just, it's totally an equation. You see, we started the period with 140,000 assets. See that? Beginning assets of 140. And at the beginning of the year, the liabilities were 60. Well, we can just mathematically determine at the beginning of the year what the owner's equity was, can't we? 140 equals 60 plus 80, right? Then it tells us during the year, $20,000 was invested in the business by the owner. So you see, we add $20,000 as an investment, and then they took out $24,000. So we'll show that withdrawal of $24,000. Make sense? Then at the end of the year, it tells us that the assets were $200,000 and the liabilities were $70,000. Do you see how owner's equity is made up of the beginning balance plus investments minus withdrawals plus net income? Net income is that residual, revenues minus expenses. So what do you think the net income for this business was? Think again. You're just not adding right, but you're making it harder than it needs to be. Oh God, I'm screwing up. You're right.
80 plus 40 minus
Yes. I'm sorry. I'm adding them all. Okay, yes.
Working our way through.
80 plus 20 minus 24. What do we need to fill it in to equal 130? 76,000. Do you guys see how you can figure out what the net income was? I want you to do something for me. Learn this, because you will have a problem on this, okay? It's really easy though, guys. Let's just take a minute and look. You set it up. If you set up it makes sense. It tells us what we began the period with. It gave us our assets and it gave us our liabilities. So can't we from that figure out our owner's equity? What if it told us our liabilities and owner's equity? Could we figure out our assets? Do you see how it's so important to know that equation in your head so you can figure it out anytime? Make sense, Jessica? So 80 plus 20 is 100. Minus 24,000 is what? 76. 76 minus the 130,000 is what? 76, 24 and 30, 54. 54. Yes. So know that based on this, we can pretty much figure out any of the missing pieces. Okay? Let's take a minute and let's go to SE3. Those of you that don't have the book, guess what? You're fine because I'm going to put it up for you. And that's page 24. No problem. I'll do this every time just so you can look along with the on the lecture. Okay, guys, let's look at this one. This one says, SE3, determine the amounts missing from each accounting equation that follows. Assets liabilities plus owner's equity. Number one, We don't know our assets, but we know what our liabilities, 100,000, and our owner's equity of 140. How are we going to figure out our assets, guys? Add the two together. Awesome. So the assets would be 240. Number 2, assets are shown at 312. Liabilities are shown at 168. How are we going to figure out our owner's equity? Subtract 312 minus 168 gives us our owner's equity. What about number 3? Subtract again. So our assets of 584 minus our owner's equity of 384 give us liabilities of? Perfect. Okay, let's look at this one. SE4. Number 2. Deo Company's liabilities equal 1/5 of the total assets. Owner's equity is 40,000. What is the amount of the liabilities? Okay, let's pull this up. Actually, I'm going to do it this way. Oops. Oh, did I just... Okay, let me pull this up. If you go to your content for week 1, you can get all your answers here. SE, what did I tell you it is?
SE4.
SE4. So look, guys, if we look at this, it's algebra.
So you said
Assets
40,000 plus A over 5
equal
put A on one side.
liabilities plus owner's equity. We know that liabilities are 1/5 of assets. See what I'm saying? So this is like algebra. If our assets equal 20% of assets, or 1/5 of assets, our liabilities are that. You get what I'm saying? Plus 40,000 in owner's equity. You basically show, it's like algebra. You take that 0.2, bring it over to the other side, and 0.8 of assets equals 40,000. You divide them both by 0.8, and you end up with liabilities are 10,000. Okay? Another way you can think about it, think of it this way. If your owner's equity is 40, do you know what I mean? And this is, the assets need to be 50 because the liabilities are only 20% of assets. But do you see how you can go about figuring this out? By taking assets, we're trying to figure, we know our liabilities are 20% of assets, and our owner's equity is 40,000. Do you see this one down here, guys? Let me make it a little bigger. Can I make it bigger? So basically, we've got assets equal 20%, the liabilities are 20% of assets plus 40,000. We bring this over to the other side and we subtract the two, so 0.8 of assets equals 40,000. We divide it by 0.8 and we see that our liabilities are equal to 10,000. That's about as tricky as it gets, but I'm just showing you how you can figure out this equation no matter what you do. Okay, guys? How are you doing? Have I freaked you out?
So you're basically taking A would be equal to 1 minus 0.2.
0.2, right. Okay, let's look at let's do one more just so you're feeling good. E5A. Okay? Now guys, as I told you, all of the problems, the answers are in here. So if during the week you want to look at some and go through them on your own, you've got the answers here to figure it out for you. E5A. Use the accounting equation to answer each question that follows. At the beginning of the year, Paulette Company's assets were $90,000 and its owner's equity was $50,000. During the year, assets increased by $30,000 and liabilities increased by $5,000. What was the owner's equity at the end of the year? So let's look at this. Paulette assets at the beginning were 90 and owner's equity was 5. What would that make liabilities? 40. During the year, assets increased by 30. So now what are assets? Instead of 90 there, 120. And liabilities increased by 5. So instead of 40, what are they now? 45. What is the owner's equity at the end of the year? Perfect. So basically, what we can do is figure that out by just creating 120 are assets, 45 are liabilities, so the difference has to be owner's equity. Does that make sense, guys? Let's look at the next one. Number 2. SE5. Okay, where am I? SE5. Let me go back here. At the beginning of the year, Carmine's company had liabilities of $100,000 and owner's equity of $96,000. So if liabilities are $100 and owner's equity is $96,000, what does that make assets? $196,000, doesn't it? Okay, you see? 100 plus 96 makes the assets of 196 there. Now it says if assets increased by 40,000 and liabilities decreased by 30,000, what is the owner's equity at the end of the year? So if assets were at 196 and we increased it 40,000, what does that make them now? 236. And if liabilities were at 100 but now are down to 70, right? Because they decreased, what's our owner's equity going to be? 166. Make sense? Kinda? Yeah? Am I boring you? Too fast, too slow, just right? Another break?
We offer it. We need water.
Okay.
So you said I'm not gonna really need this package here, right?
If you want to return it, return it.